NASDAQ hit 5,048, and 2 years later, 1114. That's a 78% free fall. If you think that's normal, trust me, you're going to love this story. Because the internet almost died, not because it failed, but because America loved it too fast. And when America loves something too fast, it doesn't date it. It marries it. It names the kids. It buys matching sweatpants. That mistake erased $5 trillion, crushed thousands of startups, and somehow accidentally cleared the runway for Amazon, Google, and the internet you live inside today. Yeah, the wreckage built the world you're scrolling right now. So how did we get here? Rewind to 1995 when the internet came with a dial-up scream. And one brutal rule. If you're online, nobody else in your house can use the phone. Picture it. Your mom is yelling, "Get off the internet. I need the phone." And you're like, "Mom, I'm downloading the future." She goes, "Downloading what?" You say, "A picture." She says, "A picture of what?" And you pause, "A cat." Then she hits you with, "How long?" You whisper, 5 minutes, and she just loses it. 5 minutes for a cat. And here's the wild part. You'd actually wait. You'd stare at a loading bar stuck at 2% like it was a heartbeat monitor. 2% for a solid minute. And when the pixels finally appeared, you didn't think, "That's it." You thought, "We're living in the future." The internet was slow, glitchy, and kind of awful, but it felt like magic. Like electricity. Before anyone figured out what to plug into it. Then the moment that changed everything happened. August 1995. Netscape goes public. IPO price? About $58 a share. And the second Wall Street saw that stock jump, they didn't see a browser anymore. They saw a new continent. You can almost hear them walking in, asking the most Wall Street question ever. "So, what do you sell?" Netscape says, "A browser." Wall Street blinks. "A what?" Netscape goes, "A door to the future." And Wall Street doesn't even hesitate, "Shut up and take my money." Because in their heads, first meant winner. If you were early, you were rich. That's it. That was the math. And here's mechanism one, the story premium. Normally, you pay for profits. In a bubble, you pay for the story of being early. The illusion that first mover automatically means winner, like buying a lottery ticket, and acting surprised when it doesn't come with a mansion. They weren't paying for profits. They were paying for the idea of owning the future before everyone else even knew it existed. And once that spell is cast, everything starts to look like the next Netscape, even the dumb stuff, especially the dumb stuff. I'm going to give you 3 red flags to spot this kind of spell later. But first, let me show you what they funded. Because this is the part where the internet turns into a casino and everyone thinks they're a genius. Suddenly, every founder discovered the same magic spell, add.com to the name, and investors started throwing money like it was confetti at a wedding. And the funniest part? Nobody cared what the company actually did. You didn't need a product. You didn't need customers. You didn't even need a plan. You just needed a website and a founder who could say the words first mover advantage without choking. Picture a pitch meeting. A guy walks in wearing a suit that's 2 sizes too big, holding a PowerPoint with 12 words on it. He says, "We're revolutionizing the future." The investor nods like he understands. Then the investor asks, "So, how do you make money?" And the founder smiles, "We don't." And the investor smiles back, "Perfect." Here's what actually changed. Normally, stock prices follow profits. You make money, your stock goes up. Simple, like a lemonade stand. But in a bubble, profits are optional. Price to earnings? Gone. Instead of valuing companies by earnings, they valued them by traffic. Eyeballs, clicks, page views. Not how much money did you make, just how many people looked at your website. It was like valuing Pokemon cards. Nobody asked, "Does Pikachu generate revenue?" They just said, "Whoa, shiny." And then paid $300 for cardboard. So yeah, your company could lose money every day as long as it was losing money on the internet. And here's the scary part. It felt fun. It felt harmless, like everyone was just playing. Until you realized people weren't betting pocket change. They were betting rent money, retirement money, their entire future on vibes. Now meet pets.com. They had a sock puppet mascot, and they burned $300 million of investor money selling 50-pound bags of dog food at a loss, which is impressive because they basically invented a business model where every sale made you poorer. And investors didn't panic. They did the opposite. You can almost hear it. Wow, you're losing money really fast. Pets.com goes, yes, investor says. That's called growth. Here's more. Then came Webvan, the company that promised to deliver groceries with the speed and accuracy of a military strike. They spent over $1 billion building a hyper-optimized delivery empire. Warehouses, trucks, systems, the whole thing. And then it collapsed, like a wet cardboard box. But nobody blinked, because the market was in full superhero mode. The NASDAQ didn't just rise, it quadrupled. Suddenly, stock charts felt like destiny. IPOs became the new celebrity weddings. Everybody showed up, everybody cheered, nobody asked if the couple had a job, and the media? The media turned into a hype cannon. Financial talk shows sounded like tech church. Welcome back to Money Madness. Today's hot tip, a website that mails socks to dogs. Tomorrow's hot tip, a website that delivers air to your house. By 1,999. The hype hit final boss level. .coms bought Super Bowl ads like they were ordering fast food. Some companies had no product. Some didn't even have a website yet. One ad basically said, "Our website launches in March. Please clap." And America clapped. Between 1,998 and 2,000, over 12,000 new .coms were born. Offices looked like daycare centers for adults, ping pong tables, nap pods, cereal bars, scooters. Teenagers were day trading between homework assignments. Your dentist had a side hustle coding JavaScript between cleanings. And everywhere you looked, the same sentence echoed like a spell. This time is different. And that's exactly what every bubble says right before it isn't. Because right around the corner, the music was about to stop. And one question walked in like a villain with a clipboard. So, how do you actually make money? That one question is kryptonite to a bubble. Because a bubble isn't a business problem. It's a spell. And spells hate questions. By early 2000, the internet party was at maximum volume. Stocks were flying. CEOs were getting magazine covers. And people were acting like the laws of gravity had been replaced with Wi-Fi. March 10th, 2000. The NASDAQ hits an all-time high, 5,048.62. Champagne flowed, office chairs rolled, and for a brief moment, it felt like the future had arrived early, and nobody wanted to ask how it was being paid for. And for a moment, they weren't totally wrong, because at the top of a bubble, everything looks like genius. Everyone looks like a visionary. Every terrible idea looks like a breakthrough waiting to happen. But then, the camera pulls back, and you start noticing things you didn't want to notice. Here's one of them. Back then, many stocks were trading at P/E ratios near 200. Let me translate that like you're 5. Imagine a lemonade stand. You earn $1 a year, and someone says, "I'll pay you $200 for this lemonade stand," and everyone else goes, "Wow, brilliant." That's not investing. That's believing in a fairy tale with a stock ticker. And then, the oxygen starts getting cut off. First, there was Y2K. People were convinced computers would break, planes would fall out of the sky, and your toaster would join a gang. So companies spent weird. Investors got jumpy. The whole system felt fragile. Not the cause of the crash, but the perfect mood for panic. Then the Federal Reserve starts raising interest rates. And higher rates are like turning off the oxygen. When money is cheap, even bad ideas can breathe. When money gets expensive, only real businesses survive. Suddenly, the vibe shifts. It starts small, quiet, almost polite. A company misses earnings. Another one revises guidance. Translation: They're out of cash and out of excuses. Then you hear the new sentence of doom. We have 3 months of runway, we're restructuring. Translation, the money faucet just got turned off. And then, the plot twist. A magazine drops a single article like a grenade. Barron's. Headline, burning fast. Basically saying, these companies are losing money so fast. The stock prices make no sense. It's the financial version of someone walking into a costume party and yelling, guys, the emperor is naked. And once that idea enters the room, it spreads like a virus. The questions come back. The boring ones, the deadly ones. So, what's your revenue? How long is your cash runway? How many customers do you have? And are you actually profitable? Some founders tried to keep smiling. We're pre-revenue. We're pre-customers. We're spiritually profitable. And that's when you realize what's happening. The story is losing oxygen. And math doesn't walk back into the room. It kicks the door down with a clipboard. Now here comes the second superpower, the money loop. Prices go up because money flows in. Money flows in because prices go up. It's a treadmill. Except the treadmill is on fire and everybody is bragging about their cardio. But once the treadmill slows down, the magic breaks. People look around and realize, wait, we're all just running in place. The selling starts slowly at first. Then it turns into a stampede. Over the next 2 years, the NASDAQ plunges 78%, from 5,048 to 1,114. Not slowly. Not politely. It fell like gravity finally remembered it had a job. That's not a dip. That's the market doing a backflip off a skyscraper. Over $1.7 trillion in market value vanishes. Depending on how you count it, total losses across tech and the broader market reached around $5 trillion. And the NASDAQ alone vaporized about $1.7 trillion. More than half of .com companies don't pivot. They evaporate. And it wasn't just companies that died. It was a belief system. People didn't just lose money. They lost certainty. Amazon loses 95% of its market value. Yahoo gets wrecked. eBay barely survives. And for a brief, surreal moment, the most stable investment in Silicon Valley might have been someone trading Beanie Babies online. And here's the wildest part. Even while the market was falling, one deal still went through. AOL, buying Time Warner for $165 billion. Yeah, that happened. And then the worst part hits. Not the charts, not the headlines, the silence. Because when a bubble pops, it doesn't sound like an explosion. It sounds like your phone not ringing. And when the phone stops ringing, you realize something. The internet didn't die, but a lot of dreams did. Then reality showed up, wearing steel-toe boots. Offices emptied. Desks got wiped clean. People carried cardboard boxes to the parking lot like it was a silent parade. Lights off. Stock options worthless. Founders turning into entrepreneur coaches overnight. Those shiny startup perks, the scooters, the cereal bars, the nap pods, ended up in dumpsters. Foosball tables too, right next to the motivational posters that said dream big. And here's the part they don't put on the chart. An estimated 400,000 tech jobs disappeared. Not moved, not transformed, just gone. One engineer walks out holding a cardboard box. There's a desk plant inside and a floppy disk he kept as a joke. He looks back at the building like it's a breakup, and he says quietly, "So, that was the future, and suddenly, nobody was laughing at the sock puppet anymore." Engineers who thought they were millionaires on paper realized the paper was worth exactly what it always was. Nothing. Companies that were once hailed as the future lost 75%, 90%, even 98% of their value. Yahoo got wrecked, Netscape got crushed, and anything with .com in the name became radioactive overnight. You could feel the entire mood of America shift. Last year, everyone was saying, "This time is different." Now the only sentence anyone trusted was, "We're sorry, your call cannot be completed as dialed." And here's the scariest part. Venture capital didn't slow down, it froze. Founders weren't getting rejected, they were getting ghosted. Emails went unanswered, meetings got canceled. The same investors who used to chase startups like hungry wolves suddenly turned into monks. And you could literally watch it happen. A founder refreshes his inbox like it's a heart monitor. Yesterday, let's hop on a call. Today, silence. He texts the investor, "Hey, just checking in." And the investor replies with the most painful 2 words in finance. "Per my last email." That's when you realize the party isn't over. It got repossessed. Because when money is cheap, everyone gets funded. When money gets expensive, the market becomes a filter. A filter that asks only one question. Do you have a real business? Or do you just have a cool story? A crash doesn't care about your vision statement. It cares about one sound, the cash register. And here's the brutal rule of the crash. The profitability filter. Real businesses live. Vibes die. If you have customers, revenue, and a working business model, you bleed, but you live. If you have hype and a logo, you vanish. But here's the twist. The crash didn't destroy the internet. It upgraded it. And right in the middle of this wreckage, one of the most insane deals in business history still happened. Remember that $165 billion AOL Time Warner deal? That became the perfect symbol of the era. The internet trying to buy the old world with imaginary money. That's not a merger. That's a financial fever dream. It's like marrying someone after one text message, because they used the right emoji. It was the Bubbles wedding photo, right before the divorce. But while most .coms collapsed, a handful of companies didn't. They didn't throw launch parties. They didn't buy Super Bowl ads. They didn't talk about changing humanity. They just kept building. Amazon got punched in the face. Hard. Its stock dropped so much, people were writing obituaries. But Bezos didn't flinch. He cut costs. He killed distractions. And he said basically, no more vibes. We sell boxes. Amazon didn't survive by dreaming harder. It survived by shipping faster. Google was still small, quiet, no commercials, no hype. Just engineers. Writing code like the party never happened. And eBay? While everyone else chased scale, eBay kept doing one simple thing well. Connecting buyers and sellers, coins, old electronics, Beanie Babies, all of it. So what separated the survivors from the casualties? One word, profitability. Not the glamorous kind. The we have enough cash to keep the lights on kind. And then we get to the hidden legacy of the .com crash, the part nobody expected. Infrastructure. Billions of dollars had already been poured into fiber optic cables, data centers, servers, and developer talent. And when all those companies died, the tools didn't disappear. The .coms collapsed, but the internet highways stayed. So when the dust settled, the next generation didn't have to invent the internet. They just had to drive on it. And then the panic got quiet. The headlines stopped screaming. And the people who survived didn't celebrate, they built. By 2003, the fog finally started to lift, and the internet came back quietly. Not with Super Bowl ads or sock puppets, but with builders. The vibe shifted from be first to make it work. And out of that silence, Web 2.0 crawled into the world like a new suit of armor. Not with fireworks, but with builders who kept their heads down and shipped anyway. Facebook starts in a dorm room. YouTube shows up from a garage. Twitter begins as a side project nobody takes seriously. No launch parties, no hype sermons, just code, platforms, and people building on top of the internet highways the .com era accidentally paid for. And then, 2007. Steve Jobs walks onto a stage holding a small glass rectangle. And that's the moment the internet stops being a place you visit and becomes a place you live. Because the iPhone wasn't just a phone. It was a portal. Suddenly, the internet isn't something you log into. It's something you carry in your pocket. Like oxygen. Constant, portable, personal. That's the real twist of the .com crash. The internet didn't die. It didn't collapse. It matured and came back quieter, stronger, and everywhere. Google isn't just a website anymore. It's a verb. Amazon isn't a gamble anymore, it's your default setting. The internet isn't a bubble anymore, it's the backbone of modern life. So, before we roll credits, I'm handing you something the dot-com era forgot to include. Protection. Because those boring questions everyone hates, they're not boring. They're armor. And if you remember nothing else from this story, remember these 3 red flags. The moment you see all 3, you're not watching a market. You're watching a spell. Red flag 1, valuations detach from reality. When people stop asking how much money does it make and start asking how big could it be, you're no longer investing, you're buying a wish. That's how you end up paying $200 for a lemonade stand that makes $1 a year. And calling it Vision Red Flag 2. The story replaces the math. When the market starts chanting this time is different like it's a password that makes risk disappear, that's not confidence, that's sedation. Because this time is different is what humans say when they're about to repeat history with better graphics. Red flag 3. The boring questions return. Revenue, cash, runway, profitability. Because the moment those questions come back into fashion, the party is already ending. At that point, you're not early. You're just still dancing while the DJ is packing up. Now, that's the dot-com bubble. But let's talk about the part nobody wants to say out loud. Because in 1999, founders added 2 magic words to their pitch and investors lost their minds. .com. Today, they add 2 different magic letters, and the same thing happens. AI. Same country. Same dopamine. Different costume. And you can literally feel the rhyme. In 1999, you just needed a website and a dream. In 2026, you need a demo with a glowing chat box and a tagline that says AI powered. Same pitch, different font. Here are 3 ways it rhymes. 1. Everyone claims they're building the future. 2. Money floods anything with the right buzzword. 3. The loudest sentence on earth returns like a ritual. This time is different, but here are 2 ways it's not the same. First, AI actually has real revenue. Not everywhere, not always, but enough to be dangerous. Second, the infrastructure is already here. Cloud, GPUs, data centers, distribution, the highways are built, which means the real winners can scale faster than .com companies ever could. So the question isn't, will AI crash like .com? The better question is, which parts are real businesses? And which parts are just the story premium wearing a new mask? Because in every bubble, the future is real, but the price is the trap. The timing is what destroys people. So if you ever feel the market pulling you into the spell, remember the .com era. Remember the sock puppet. Remember the billion-dollar grocery fantasy. Remember 5,048, becoming 1,114. And remember this, bubbles don't disappear. They evolve. The market doesn't repeat. It rhymes. Oh, and one more thing. In 1999, we paid 5 minutes to download a cat photo. In 2026, we might pay $5 trillion to chase a chatbot. Same dopamine, different costume. So tell me, are we building the future? Or are we just downloading another cat picture with a nicer interface?